The stock market will always be an unstable source of income, and the market watchers are very much vigilant about any slight movement. But is the stock market really at risk in 2023? The positive development is that the S&P 500 index indicates a 14% year-to-date increase in the U.S. stock market by June 28. However, cautious market observers remain vigilant and are not assuming these positive trends will persist without question. Welcome to Nova Society, the world's best finance channel for personal finance. If you are interested in this kind of video content, then this is the perfect channel for you. Make sure to like this video, click the subscribe button, and turn on the notification bell to keep you updated on our recent uploads. High inflation. Undoubtedly, the inflation rate in the United States is declining. However, the initial concern lies in the fact that inflation had reached excessively high levels, reaching a peak of 9.1% in June 2022. Fortunately, by May 2023, the inflation rate had moderated to a more manageable 4%. While this is positive news for stocks, money managers remain vigilant, closely monitoring key inflation indicators in sectors affected by high inflation. Craig Studnicki, the CEO of ISG World, a real estate development firm, acknowledges that although inflation is currently somewhat contained, there is still a potential for it to rise again. He emphasizes that inflation has crucial effects on both the U.S. and global economies and ideally should be maintained within a range of 2% to 3%. The sustainability of the ongoing Wall Street rally is closely linked to the reduction of inflation. Studnicki highlights that if inflation persists at elevated levels, there is a risk of the rally losing momentum, which would significantly impact the overall health of the stock market. Volatile housing and construction trends. The U.S. housing market demonstrates resilience, as indicated by CoreLogic's projection of a 4.6% growth in home prices for the 12 months beginning in April 2023. Additionally, housing starts experienced a notable surge, reaching an adjusted annual rate of 1.631 million units in May, marking a 21.7% increase compared to April. This represents the highest surge in housing starts since April 2022. While these developments bode well for the economy and stocks, it is important to note that the housing market still faces challenges. Craig Studnicki emphasizes that inflation has an impact on construction projects, as higher interest rates create obstacles in getting necessary loans. If inflation does not cooperate, some projects may fail to materialize as originally planned. Recessionary shadows. Not long ago, investment banking analysts were predicting a substantial U.S. recession in either 2023 or 2024. However, the tone surrounding these predictions has now shifted to a more moderate stance, although discussions regarding potential downsides have not entirely disappeared. An example is Goldman Sachs, which initially indicated a consensus probability of 65% for a U.S. recession in January 2023. Since then, Goldman Sachs has adjusted its recession likelihood to 35% and most recently to 25%. This adjustment primarily reflects the diminishing concerns related to the Silicon Valley Bank collapse and the potential crisis in the banking industry. Jonathan Mary, CEO of MoneyZine.com, a platform offering financial and investing advice, emphasizes that while the risk of a recession still looms, it is now less likely to occur. However, Mary warns that if a recession were to happen, it would likely lead to a bear market. High interest rates. During June, the Federal Reserve chose to keep benchmark interest rates unchanged, with the key federal funds rate remaining at 5% to 5.25%. However, the Fed surprised Wall Street with its announcement that it is likely to raise interest rates 2 more times in 2023. Although this analysis from the Fed is a projection and not a certainty, it reflects the Fed's ongoing caution regarding the potential resurgence of inflation. The Fed's message conveys a hawkish outlook should inflation experience a significant increase. According to Mountford, the concern lies in the limited spending capacity of consumers. High interest rates have dampened borrowing, which, in turn, has had a stagnating effect on the housing market. Additionally, wage growth has not kept pace with inflation. Mountford emphasizes that consumers need to spend to generate sustainable revenues that support the stock market. A narrow stock market. The business press has extensively covered the phenomenon of 10 large-cap U.S. companies driving the majority of stock market gains this year. These companies, including Apple Incorporated, Alphabet Incorporated, Meta Platforms Incorporated, Microsoft Corporation, Nvidia Corporation, Amazon.com Inc., Tesla Incorporated, Broadcom Incorporated, Advanced Micro Devices Incorporated, and Salesforce Incorporated, have contributed to approximately 90% of the overall stock market returns in 2023. However, this concentration of gains in a select few stocks raises concerns about the health of the broader stock sector. According to Scott Peterson, owner and wealth manager at Harmony Wealth Management, the S&P 500's performance has been heavily reliant on a small group of large-cap tech stocks. Without them, the S&P 500 index would have shown minimal growth. Peterson emphasizes that for the rally to sustain, it needs to encompass a broader range of stocks beyond just the dominant tech giants. Citing Bob Farrell, the former chief stock market analyst and senior investment advisor at Merrill Lynch, Peterson highlights that markets tend to be strongest when they exhibit broad-based strength and weakest when they become narrowly focused on a few blue-chip names. Therefore, a more robust market rally would involve the participation and upward movement of value stocks and smaller-cap companies. Election cycle. Typically, the third year of the four-year presidential cycle, which is the current year for the U.S. in 2023, tends to be the strongest in terms of market performance. According to Peterson, referring to the historical composite for the S&P 500, the market tends to experience a rally until mid-July, followed by a period of sideways movement before another rally towards the end of the year. Historical data suggests that if the S&P 500 has gained more than 10% by June, it is likely to continue its upward trajectory in the second half of the year. Technology stocks. The Nasdaq 100 index, the benchmark for technology stocks, has been experiencing strong momentum in 2023, with a gain of 36.8% by June 28. Investment experts believe that the winning streak for technology stocks can continue. James Allen, founder of BillPin, a money management services platform, highlights the potential of the technology sector, particularly companies involved in artificial intelligence, despite the overall market's high volatility. However, there are certain risk factors to consider, such as challenging pricing conditions for electric vehicles, which could impact companies like Tesla. Increased competition and potential obstacles for generative AI could pose challenges for companies like Alphabet. Although technology stocks may be costly based on valuation, they offer growth opportunities even during economic slowdowns. Scott Peterson emphasizes that large-cap tech companies have strong cash flows and do not rely heavily on external financing. He suggests considering adding technology stocks to one's portfolio during sector pullbacks. As the stock market currently appears to be stable, it is up to the market watchers and their capacity to see the factors that they might need to consider in terms of taking risks in the stock market. It's good money, all right, but you must also be willing to lose what you invested. If you want to learn more about personal finance and generational wealth building strategies, visit our channel and subscribe for more enlightening videos to increase your wealth.